Aditya Welekare, metal analyst at Axis Securities, joining us for all of that perspective. Aditya, very good morning and great to speak with you today. So, first of all, how much do you think this is going to impact steel company prices today or steel stock prices today as a sentiment? Would it be taken very seriously?
Sentimentally, it's a positive step, but if you see at current spot prices, the Indian steel HRC prices are still trading at a premium of 8% at 7.5% customs duty. So if they increase the customs duty to 12%, then the premium drops down to 4%, but it is still not at parity with the Chinese prices. So they will have to raise the customs duty at least to 17 to 18% to get at parity with the Chinese steel prices. So even if they increase to 12%, Indian steel prices will still trade at 4% premium to the Chinese prices. So the real trigger will happen if there is some positive pickup in Chinese steel demand. We expect that as the autumn season picks up and the monsoon gets over, there might be some pickup in industrial machinery and construction activity. But it's still too early to say. We will have to continuously monitor because globally, including US and China, the PMI prints are in the contractory zone. So, but we are hopeful that there might be some relief post this as the autumn season picks up.
So as I understand it, the actual global demand for steel, and especially from China, is a bigger concern than the import duties that we currently have on import of Chinese steel. Having said that, Aditya, just in the context of, if import duties are increased, indeed increased, which are the steel companies which would be most beneficial?
So it will benefit almost all the steel mills because ultimately it will put off the pressure on domestic steel mills to as they compete directly with the Chinese HRC prices. But as I said, the quantum of the customs duty increase from the minister's comment of 10 to 12%, it should be higher. It should be at least up to 18% to get at parity with the Chinese prices. So that's point number one. But the root cause ultimately will be decided by the Chinese steel prices and the demand in China domestically. Because if that doesn't pick up and China continues to dump and export higher steel, in the first 7 months of this calendar year, they have already exported 60 million tons of steel, and in calendar year 24, there are expectations that these steel exports from China will touch 100 million ton, which will be the highest figure since 2016. So ultimately, there should be some pickup in activity from China, which we are looking as a positive trigger for this steel sector. If it doesn't play out and that the demand from China continues to remain subdued, then the pressure on the domestic steel mills will persist.
Aditya, just a couple of other factors that stand out. Indian companies have lower leverage than Chinese steel companies as per Moody's report. Raw material prices for steel companies have been reducing. We also understand that JSW Steel has hiked prices from 750 to 1,000 rupees per ton. And we're concerned about Chinese dumping, right? Keeping all those factors in mind, where are Indian companies getting the confidence to hike prices because margins have improved? And secondly, also, while there's all this talk about double-digit growth, in your pecking order, which are the top 3 companies that could benefit on back of lower leverage and better margins and price hikes?
So as far as steel stocks are concerned, we are still slightly positive on non-integrated players like JSPL and JSW Steel. We are slightly negative on Tata Steel and SAIL. Tata Steel has multiple issues with respect to their UK asset restructuring. They have a long road ahead in order to restructure the UK assets. SAIL is structurally cost sensitive and price sensitive company, so we are slightly negative on SAIL. Also, its history with respect to its capex management and modernization program is not very good, and they have exceeded their previous expectations of capex in order to increase their steel production. So we think the drop in the raw material prices like coking coal and iron ore, that will be slightly beneficial for the non-integrated steel players. The drop in HRC prices definitely gets partially offset by this drop in coking coal and iron ore prices. But still, in the second quarter two of this fiscal, we expect that the steel spot spreads will be slightly under pressure on a quarter-on-quarter basis, maybe 1 or 3%. On a year-on-year basis, a rough calculation says that the steel spot spreads will be in the range of $350 to $360 per ton from the last year's $450 to $460 per ton. So that is the quantum of impact because of the fall in the HRC prices.
Thank you, Aditya. Great chatting with you this morning, and thank you for sharing with us your top recommendations and steel stocks that you actually like in this space.